So let's get right to it. Today's Monday action. We have Rob Stein, Astor Investment Management CEO, is going to tell us why stocks will head higher and 3 ways you can play the rally. Pete Lang, Lang Capital president, says rising interest rates are going to be a big problem for the Fed and for investors. And Bob Iacchino joining us from the CME. Bob, I want to start with you. Why all the bad news on this gloomy Monday?
Well, I don't know if it's bad news. You've got an overall market that's feeling really, really heavy. Commodities look sort of like a canary in the coal mine. They're very, very weak. You look at what's going on with gold, silver, crude oil especially. Crude oil is a demand story at this point. It's not necessarily supply outstripping strong demand. There's just no demand coming out of Europe and China, at least no perception of future demand. So it's weighing on stocks heavily. I still think this is going to be the dip that you buy. You talked about the Russell. The Russell entered correction territory, recovered a little bit, and then it's turned back around pretty heavily. That's going to lead the rest of the indices down, but this is still the place to put your money. This is still a bull market. It's looking back for that correct level. I think that level is coming in a day or two.
Rob Stein, you're bullish. I mean, overall, you think that, barring any fundamental problems with, I guess I'm assuming, the economy, you think that we are going to have positive numbers out of stocks for the next couple of quarters. But what about employment? What about a hit to GDP? Is there anything that you think could derail the decent numbers that we've had over the last few sessions?
Yeah, I mean, I think if you get, an awful GDP reading in Q3 after, a phenomenal reading in the second quarter, and you get employment trends to not be as robust. We've added several 100,000 jobs on average per month for a long time now. If that starts to dip below 100,000 and you get GDP back in that 1% range, not continuing that 4% number we had or something close to that, you might start to see a stall in the economy, and that would be reflective in stocks. But right now, we think the risk of owning stocks, and there is risk in owning stocks, is worth the return that you'll have a few quarters out.
Pete Lang, I want to talk about Alibaba for a second, because you wrote something very interesting saying that the Fed's money is going to China as a result of the Alibaba IPO. What did you mean by that?
Well, what we've all got to remember is that we're in a global economy. So when you take a look at Alibaba coming in and taking $20 or $25 billion off the table, in essence, we got to look back at what the Fed has done since 2008. And they've injected about $10 trillion into our economy. Unfortunately, most of that money didn't find its way into the consumer's hands. In fact, about 2/3 of it, or $6 to $7 billion, likely went into longer-term investments or stocks. So when I say maybe some of our money went over to China, it's a tongue-in-cheek analogy that our Fed is supporting essentially a private market, and a lot of that money is flowing out into public companies, for example.
And we're going to be talking about Alibaba and, of course, Yahoo coming up in the next portion of the show. But I do want to ask you, Bob, we did see a move into bonds today. Piece of that seems to be the existing home sales data we got this morning, which was actually fairly negative. What did you see?
Well, we see yields rising, and we're going to continue to see that since the last Fed meeting. The Fed sort of bumped up their hawkish tone in terms of their predictions on rates. But that really, again, the Fed they don't stick to their predictions. They're not very good at predicting what's going to come out of the economy. They haven't been. This is the first really real adjustment, real hawkish adjustment out of Janet Yellen. Treasuries are playing that out. And I think one of the things that people are going to struggle with is down the road they're going to see that they can actually lose money in bond funds. And some of that money, I think, is going to shift back into equities. I don't think it's going to be bad for equities because I think it's been orderly, and I think it's going to continue to be orderly.
Rob, you're bullish, but you say the thought of deflation keeps you up at night. Explain.
Yeah, I mean, if you had to pick one thing to worry about, it's not the geopolitical events, it's not the Alibaba IPO, it's that the inability for the Fed to reinflate the economy. Right now, the velocity of money, how much times a dollar circulates through the economy, is at very, very low levels. The Fed's balance sheet that you pointed out is a balloon, but that's not getting into the money supply, and those are a recipe for a deflationary environment, and that could be a big, big problem. We saw what happened in Japan over the last decade, and if you were to ask me to pick a concern, it would be that we're in that position for a lot longer than we would like.
If we are, by the way, how do we get out of it?
Yeah, that's the tough one. It's a complicated thing. It's not like inflation where you raise interest rates or you a slowing economy where you just flood the economy with money. Getting out of a deflationary spiral is a lot of different moving parts to it. Wages need to adjust on the downside, something that's very, very hard to do, and borrowing needs to be handled in a different way. It's a much, David, different problem than inflation or a slowing economy.
Pete, let's talk about some of your picks. I think they're actually interesting because, well, they're strong consumer names. AT&T, you like that one. Waste Management, Paychecks. Start with AT&T. Does this have anything to do with the launch of the new iPhone?
Well, absolutely not. But I'd like to step back and just tell you this. When you look at the economy as an overall, we could have some significant pressure in upcoming months. First of all, we've got quantitative easing coming to an end next month. I think the Fed's hiding the ball a little bit right now, talking about interest rates so much.
Well, but
so let's see what happens
picks,
next
though.
month.
Let's talk about your picks,
okay.
though.
So back to AT&T.
Let's go with AT&T. Why do you like it?
I love AT&T. If you look at the beta or how that stock performs in a downward spiraling market, it's got a beta of about 25, very, very low. It's also paying a phenomenal dividend, about 5%. This is the kind of equity that you want to be in if you see a little tension or a little bit of market volatility coming in the future.
And Rob, as we look at oil prices going back down to the 89 mark, it's 91.40. That's how it ended the day. But looks like there is a downward draft continuing there. Is it time to buy into energy stocks?
Yeah, I like the energy sector. I do think there's still going to be demand for energy. I also think profit margins are expanding right there. We like to play that through various ETFs. We also like the technology sector and the healthcare sector, also played through ETFs.
Rob Stein, Pete Lang, thanks, gentlemen. Bob Iachita, we're going to see in a couple of minutes when the S&P futures close. Thanks a lot.